1. Understand the basics of stock investing. What is a stock? A stock represents ownership in a company. When you buy a stock, you own a small piece of that company. Why invest in stocks? Stocks have historically provided higher returns compared to other investments like bonds or savings accounts, but they also come with higher risk. Risk vs reward. The value of stocks can go up or down, so you could lose money. Diversification and a long-term perspective can help manage risk. 2. Set clear financial goals. Determine why you're investing, for example, retirement, buying a house, building wealth. Define your time horizon, short-term vs long-term. Assess your risk tolerance. How much volatility can you handle? 3. Learn the key concepts. Diversification. Don't put all your money into one stock or sector. Spread your investments across different industries and asset types. Dollar cost averaging. Invest a fixed amount regularly, for example, monthly, to reduce the impact of market fluctuations. Compound interest. Reinvesting earnings allows your money to grow exponentially over time. 4. Choose an investment account. Brokerage account. Open an account with a reputable online broker, for example, Fidelity, Charles Schwab, E-Trade, or Robinhood. Retirement accounts. Consider tax-advantaged accounts like an IRA or 401k if you're investing for retirement. 5. Start with index funds or ETFs, recommended for beginners. Index funds. These track a specific market index, for example, S&P 500, and offer broad market exposure with low fees. ETFs. Exchange-traded funds. Similar to index funds but trade like stocks. They're a great way to diversify without buying individual stocks. Examples: Vanguard S&P 500 ETF, VU, SPDR S&P 500 ETF, SPY. 6. Research individual stocks. Optional if you want to invest in individual companies. Understand the business. Invest in companies you understand and believe in. Analyze financials. Look at revenue, earnings, debt, and growth potential. Valuation. Check if the stock is fairly priced using metrics like P or E ratio, price to earnings. Long-term focus. Avoid chasing short-term trends or hot tips. 7. Start small and stay consistent. Begin with an amount you're comfortable losing. Gradually increase your investments as you learn and grow more confident. 8. Avoid common mistakes. Emotional investing. Don't panic during market downturns or get overly excited during rallies. Timing the market. It's nearly impossible to predict market movements. Focus on time in the market, not timing the market. Overtrading. Frequent buying and selling can lead to high fees and taxes. 9. Monitor and rebalance your portfolio. Your investments periodically, for example, quarterly or annually. Rebalance your portfolio to maintain your desired asset allocation. 10. Keep learning. Read books like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel. Follow reputable financial news sources, for example, CNBC, Bloomberg, or The Wall Street Journal. Consider taking online courses or joining investment communities.